G'day and welcome to the Investment Motivation Podcast and also YouTube. We're doing ourselves a quick video to cover off last night's budget. And welcome, Amy Lehman.
Hello, everybody. Yeah, this one is a little bit different. We've got to go on the YouTube this time. We're doing a recording. So if you are generally a listener but you would like to see Rob and I talk, feel free to go over to the YouTube and you can do just that.
Yeah, it might be easier just via the audio.
Yeah.
Last night, so Treasurer handed down the budget and, the first time in 15 years there has been a surplus. We've had very high export earnings, so some quite good positive news. Obviously, higher incomes and tax receipts for people, and obviously, higher exports. But before we leap into that, we better do the acknowledgement of land.
Before we get into all of that, I will do the quick acknowledgement of land. On behalf of the Investor Motivation Podcast, I would like to acknowledge the traditional owners of the land on which we record this podcast and pay respect to elders past, present and emerging.
Fantastic. Thank you, Amy. And what our goal here today is to keep things high level, where we're not going to dive right into the detail, but we'll cover off as much as we can, and we'll break it up into different segments. And we'll kick off with superannuation. And there's just, I suppose, a few things that that they've confirmed, some things they didn't even mention. One of the things they didn't even mention was whether the continuation of the pension discount of 50%, which we've seen for the last 3 or 4 financial years. They didn't mention that at all. So we assume that from the 1st of July, the 50% discount that we've had is going to be gone.
Yeah. So that was the one that was introduced for COVID to, mean, people weren't spending as much, so they halved it. And they haven't said they're going to revert that away. Sure.
Yeah, and that preserved assets within superannuation for later on. And it also helped out a lot of our clients' self-managed super funds where they're significant farming land or big business property ownership in there where the values have gone up, which will cause a problem moving forward.
Yeah, making sure people have enough liquidity in their superannuation to be able to cover those minimum drawdowns will be a big consideration for people with self-managed super funds especially.
Absolutely. Now, I just slipped in front of you, Amy, just the change that they're looking to do at, I think it's 1st July 2025, where they're talking about the $3 million and over.
Yeah, so we did have an announcement on this one, and we've already done a podcast on it as well. But again, they just reiterated that the total super balance will go up to the $3 million mark, and anything above that will be taxed at 15%. So if you're in pension phase and you're used to having that free tax threshold, it's going to now be at the 15% tax.
Please remember that is at an individual level. So for a self-managed super fund where you might have up to 6 members, it's per individual, per member, not per fund.
Yeah.
And strategizing around that. Obviously, we've got time to think about it. There's a decent lead time, and 30% for may not be too bad. It depends on what income you receive in your individual name. So, got a little bit, like anything, it comes with a lot of complex calculations.
Yes.
That, one rule affects so many others, and there's a flow and effect that, unfortunately, things just continue to get complex.
Yeah. All that income things as well and earnings above the $3 million, the best person for you to talk to would definitely be your accountant, as they would be able to assess your individual income as well as the tax on the earnings above the $3 million, and they'll help you decide whether it is worth having assets in your own name or if it's still okay and more tax efficient in super.
Yep, even one better, catch up with the accountant, drag your financial advisor along, because every appointment I have where the accountant and the financial advisor with the client in the same room, every question gets answered.
Yeah.
They're great appointments, and your professionals should always work as a team for your benefit.
Yeah, definitely.
Yeah. Another change they're looking to do, be patient with this one, from 1st July 2026, is that your employer superannuation guarantee payments need to be paid in the same, I suppose, same
pay cycle.
Consistency is when you get paid. So if you get paid fortnightly, your superannuation contributions need to go in fortnightly as well. Yeah. So be patient with that one. At the moment, it's based on a quarterly basis.
And that's not set to go into effect till 2026. Yeah. So be patient, but that will be really, really helpful when it does go in, as you'll be able to start accumulating the earnings on that money as it goes in. You don't have to wait each quarter.
Correct.
So, yeah, compound interest-wise.
And they did some calculations. I think it's worth about $6,000 for a 25-year-old at retirement.
Yes.
Rock on for that $6,000. In the self-managed super fund world, they're talking about non-arm's length income and expenses, and that might be an example where an accountant does their own tax return for their self-managed super fund, and that would normally be charged out at $3,000, but they charge that out at $1,000. So they're essentially giving themselves the fund a discount. Not allowed to do that. It's got to be at arm's length. And so in the past, so looking to change from this next financial year, 1st July 23, that the penalty rate of 45% will be applied to the amount of money that should have been charged times by 2. So if you've undercharged by $2,000, you'll be taxed at 45% on 4. And that's come down from 5 times the multiple of the undercharge. So again, don't want to go into really detail there, but that's broadly, you got to make sure that everything you do in self-managed super fund world is at arm's length and at commercial rates. And this doesn't affect, the larger funds that are out there. We've already covered off on pensions returning to normal based on them not saying anything at all on it at all. Amy, big one. I think it's worth definitely commenting on that.
Yeah, so again, with this one, we have had an announcement before this budget was released, but it is that the transfer balance cap is going to be increasing from $1.7 million to $1.9 million. So that's from any pensions commencing at 1 July 2023. You'll be able to put up to $1.9 million into pension phase.
Correct. And of course, that's your transfer balance cap. There are rules about how much money you can put into superannuation as non-concessionals, depending on, if you're above the transfer balance cap, which was initially 1.6, then now 1.7, about to be 1.9.
Yeah.
So that will mean that will increase potentially what people can put in. And obviously that's indexation that's having an effect on that.
Yes.
And one thing that was confirmed, that indexation on the 3 mil won't happen.
No, yeah.
Yeah, so people above that 3 mil, what I should have mentioned back at the start, there is no indexation to that. So with inflation running the way it is, that, in 10, 15 years' time, 3 mil is not going to be the monster number that it is now.
Yeah, definitely. And it's also probably worth mentioning that even though they're indexing this transfer balance cap up, they're not indexing the contribution amounts. So next year's contribution caps will be in line with the current.
Cool. 110 non-concessional.
Yep. 27.5 concessional.
Well played. Thank you, Amy. All right, that's enough for super. Let's drift on into the exciting world of tax. So, more, are you awake? Yes, you're awake. No, tax is important and good to understand. Now, we've spoken a lot about understanding your marginal tax rates, and there's obviously different levels. We've got
brackets.
Got them here. But let's just break it down pretty simply for you, that they've essentially made no adjustments to what they're calling the legislated stage 3 personal income tax changes. So from from the 1st July 24, so only next year, essentially they're getting rid of a whole tax bracket.
Yeah.
So we've often spoken about from $45,000 to $120,000. With Medicare, you pay 34.5 cents on the dollar tax. And then above that, it's 39 up to 180. Then above that, it goes to the top tax rate, which is 45% plus Medicare.
Yep.
So from 1st July next year, they're getting rid of that 39% tax bracket. So it's from 45 grand all the way up to 200.
Yeah.
It's going to be 30 cents on the dollar plus Medicare. So they're reducing it from 32% down to 30, and it's all the way from 45 grand to 200.
Yeah.
So
it does benefit the high income earners a bit more than the lower income earners, as it is all the way up to that $200,000 limit. They have released some comparisons of what the tax saving might be. If you earn $200,000 income, you will be benefiting by $9,075 in tax. Whereas if you only earn $50,000, you'll only be benefiting $125 from this. So it does benefit the high income earners more, but it's still a tax saving across the board.
Yep, fantastic. So So that's positive for a certain segment of the population.
Well, yeah.
Yep. Let's leap on into Social Security and Centrelink and look at what's happening there. And I think what the government's tried to do here is acknowledge that inflation has had a significant effect on people on lower incomes, people that are on Centrelink payments, like job seeker, parenting payments, and so on. And so for job seeker, youth allowance, parenting payment, Austudy, and disability support pension for you, special, all these different payments. There's a $40 per fortnight increase that's going to kick in from the 20th of September. I hope that's enough for people to make a difference for them. So fingers crossed that it's the case. And people that you're getting rent assistance, there's also an increase of 15% there. So for a couple combined would currently get 147 is the maximum amount of rent assistance they could get. That goes to just over $170 per fortnight. So again, an acknowledgement that the cost of living has really gone up significantly. Very good. Anything else you'd like to add to any of that, Amy?
I think that's probably pretty good for the Centrelink side of things.
The sole parent payments would cut out for the youngest child normally at age 8.
Yeah.
That's going to be increased to age 14. So they believe that's going to have a pretty significant impact on about 60,000 people in that position. So that will help them out no end. Obviously, that's, again, people that struggle in our communities. The government is trying to look out for them. So that can only be seen as a positive. Amy, aged care.
Perfect. So the government have released another aged care package to help fund aged care. They've released another $166.8 million, which is equivalent to about 9,500 home care packages. So that, just means people can get more support at home, and it's exactly what we mean with the ageing population.
Great, and that would put less pressure on aged care facilities that are struggling with beds as it is. So keeping people at home for longer is definitely part of what's happening here.
Yeah.
And I suppose there's a huge cohort of baby boomers and retired people coming through the system, so they need to be supported. And it should have probably been in the tax side of things, but the small business instant asset write-off. So from 1st July this year, 2023, until 30 June next year, eligible small businesses, and this is with a small business with aggregate turnover less than $10 million, can, I suppose, fully write off or deduct the cost of any eligible asset less than $20,000. Anything above that, then it goes into your depreciation pool as normally. And so talk to your accountant about that issue. That's definitely not our field of expertise.
No, not at all.
Excellent. Very good.
I think that's about it.
I think so. Thank you very much for listening and or watching for those that have tuned on via YouTube. Appreciate the support. Please reach out if you've got any questions, any topics that you would like covered. And for those that are listening via our podcast, we have over 520 videos on our YouTube channel and growing. And so lots of it is all education based.
Yeah, go check it out, people.
Cool. Thanks for listening.
Till next time.
See ya.
Bye.